try and get through. You can see there the first 8 chapters. Apologies, the dates. No, the date's right. The first 8 chapters or so. Now, bear in mind, it's sort of an abridged version, so we can't go into the detail. It's very much a summary. In terms of the exam, it's similar to last year, and last year's is up on Moodle. So you've got 10 multiple choice questions, similar to what we went through in class a couple of weeks ago. They're worth 25 marks. Then you've got 4 longer form questions. You've got to pick 3 of those, and they're worth 25 marks. And obviously, they're broken into sections between kind of 2 and 3 sections in each of those long form questions, and the paper is 2 hours long. And just to flag as well, there'll be some summary notes. The full-time lecturer is putting together some summary notes, and they will be available. They'll be available next week. So just kicking into this sort of refresh. So that is just chapter 1, your textbook. So this kind of goes back to the basic stuff, and we'll just kind of get through the earlier chapters quickly and then slow down as we move to the more weighty stuff. But just again, we just looked at the intermediation function, and that was just how do banks work, and necessary, and I suppose it's necessary to understand the role of financial intermediation in an economy. So what's intermediation? And we spoke about the whole concept. Well, intermediation is essentially a middleman, like you might think about an auctioneer who acts as a middleman between a buyer and a seller, and taking a cut from facilitating a transaction. A bank then will act as a middleman by connecting borrowers and savers, and they will take a cut for facilitating the transaction. So banks collect surplus funds from savers, allocate them to those people that are in deficit of funds, be it companies and people like yourself and myself trying to buy a house. In doing so, then they channel funds from savers to borrowers, thereby increasing economic efficiency and, I suppose, promoting better allocation of resources. Those who lend then have a financial claim on the monies they lent, which obliges the borrowers to pay interest and repay the funds either whenever requested or after a stated period of time, depending on the loan agreement. And I suppose this is a form of indirect finance. Moving on then to the next slide, and this kind of goes into, I suppose, more modern financing, and there's both direct and indirect financing involved. And clearly, a borrower doesn't need to go through a bank, i.e. direct, to access funds. They can also go for direct finance, and in this instance, borrowers will go directly to the market to raise money. So if you think of the Irish government, it raises money directly from international investors, be they savers and depositors, via the financial markets or the bond market as it's called. And obviously savers can then also directly invest in the bond market if they wish to do so. So I suppose, banks who act as intermediaries in providing finance, as covered in the first slide, also can get direct financing from the markets to have it as part of their funding mix, and also to sell loan assets on the financial markets by packaging them up into marketable instruments. Can anyone tell me what that process is called? The marketing up or the packaging up of a bunch of marketable instruments is called that process. If it's a collection of loans. Don't rush all at once. Securitization, and I would remember that. So what's the benefits for banks? Well, it allows better management of credit risk as you've passed most of the risk to a third party. So if you sail a big group of loans into the market, then you're no longer on the hook for the majority of that credit risk. You're obviously then not exposed to the interest rate risk tied to those loans. You get paid for the assets, then you've got more liquid capital or tier 1 capital on your balance sheet, which you can, hold as capital. You can look to distribute it to your shareholders, or you can use it to originate more loans. And they could be in the form of different types of securitization products, and you can have mortgage-backed securities, which are called MBS. You can have asset-backed securities, which are ABS, and so on and so forth. The next slide there, then, just in this one, just shows, I suppose, really just the relationship between the return the bank can expect from a certain loan and the loan price, and the loan price is increasing and positive up to a certain point. In this example, it's up to a point where borrowers are prepared to pay about 6%. Any price above that level, represented by that shaded area on the right, will decrease the expected return for the bank, and that's known as a sort of adverse selection. So what does that mean? Well, only the most risky borrowers will be ready to accept a loan at a very high price, because likely they can't get a loan anywhere else, and they're less creditworthy. This creates obviously an issues around in particular moral hazard. I suppose this is the risk that the borrower might engage in activities that are undesirable from a lender's point of view, which make it less likely that the loan will be repaid and thus harm the interests of the lender. So financial firms such as banks, insurers, therefore seek to screen out or monitor such customers by accessing their kind of risk profile and adjusting insurance premiums and loan rates to reflect the risk that of the individual client. To do this, they do credit checks and credit scoring. And credit scoring, just as a reminder, is like a qualitative evaluation employed by banks to assess the creditworthiness of an individual or firm when they're applying for a loan. That kind of explains why a mortgage will be priced at a lower rate than a personal loan, because if you can borrow it for a mortgage, say at the moment maybe at 3.5%, but maybe a personal loan is about 7%. The reason being is a personal loan, it's not secured on anything, and it's hard for the bank to get their money back if you decide not to repay, whereas a mortgage is secured on a property and the bank can always take the mortgage off you, so they got security, and therefore that's why the pricing is lower. So just in terms of I suppose summary points there on chapter 1, as you can see, so banks, as other financial intermediaries, they kind of play a vital role in the economy, channeling funds from units in surplus, i.e. savers, to units in deficit, i.e. borrowers. Banks address the different needs of borrowers and lenders by transforming small size, low risk and highly liquid deposits into loans which are of large size, higher risk and illiquid, and they get paid to do that. In terms of indirect finance, that's conducted by intermediaries, versus direct finance is where the borrower gets the funds directly from the market. We touched on the concept there of adverse selection. That's the relationship between the return the bank can expect from a certain loan and the loan price is increasingly positive up to a certain point, and then any price above that point, that there is a decrease in the expected return for the bank, as you're ultimately will only end up lending to borrowers you effectively don't want to lend to. Credit checking and credit scoring are undertaken to ensure borrowers are a good risk. Credit scoring, as a reminder, is a qualitative evaluation undertaken by banks to assess the creditworthiness of an individual or firm when they're applying for a loan. Okay, that is chapter 1 covered off. So getting into chapter 2 then, so and this was, you know, quite a good but simplified chart. So in order to better understand, I suppose, how banks work, you need to look at the financial statements, in particular the balance sheet. And I suppose this slide, as I said before, just shows a very simplified balance sheet. You can see on the you can see on the left hand side there, you've got your assets, which are your cash. You've got things that you convert into cash quickly, such as your bonds, your fixed assets, for instance, might be the building that the bank occupies. The two areas really we're focusing on, I suppose, are the loans on the asset side and the deposits on the liability side. Now, when we dealt with this in week 2, we just noted that some people might struggle with that because it seems quite counterintuitive. But if you think about it, a loan for the bank, it might be a liability for you, but it's an asset for the bank. On the flip side, a deposit might be an asset for you, but it is a liability for the bank. You know, so and effectively the bank owes you back at some point, you know, the cash that you put on deposit with them, and you owe them money back on the mortgage you took out with the bank. Just moving on then to the next slide. So there are, I suppose, separate classifications for, you know, the different financial intermediaries or middlemen. For reference, the bank, as I noted previously, looks at this from kind of a UK lens, but, you know, there aren't that many dissimilarities, you know, with respect to an Irish context. On the left-hand side there, you can see those institutions that take deposits, like banks or building societies. Building societies in particular, they specialise in savings and mortgages, and are similar in many ways to credit unions. The main difference between a bank then and a building society is a building society, they're run by their members. They're run and owned, should I say, by their members, versus who owns the bank. The bank is typically owned by shareholders, and they're typically on the stock market. But these two represent monetary financial institutions, as you can see there on the bottom left. Now then, what do we mean by discretionary flow of funds on the top left there? Well, this is really just talking about, means depositors are free to decide how much money they put in and for how long, and they can withdraw it whenever they want, or they have the discretion to withdraw it. However, when you flip to the right-hand side of that slide, we're dealing with non-deposit taking institutions, and they could be, you know, pension funds, investment funds, etc. And they usually require a contracted flow of funds and hence fall into the bucket, as noted there, as financial corporations other than monetary financial institutions. For instance, an example of this, as we outlined in the lecture, was when you start your first job, your employer may make a contribution towards your pension on your behalf, say, I don't know, 5% of salary or what have you, and they will pay that contractual fixed amount of your salary into the pension fund each month on your behalf. So that's contractual, and they have to pay it, versus, as we dealt with the banks, it is irrespective of depositors. They're free to decide how much and for how long they put money in. Looking then at, I suppose, banks' core activities. So what do banks do in the main? And we kind of touched on the core activities in the previous slides there, but, you know, they take on deposits and they lend out money. So they take deposits from savers, and then they lend out money to borrowers. They're also obviously involved in trade finance and cross-border services. Essentially what we're talking about here is where a bank acts as a third party to remove payment risk for the seller and the supply risk for the buyer. For instance, the buyer or importer's bank might provide the seller with a letter of credit to evidence the fact that the buyer has sufficient funds to complete a transaction. Then when the buyer's bank is given evidence that the goods or services have been shipped, let's say from, you know, the UK to Ireland, where the buyer resides, the buyer's bank will release funds to the seller. Other financial services maybe, for instance, the facilitation of buying and selling of some form of insurance products, for instance, and then obviously, payment services where they facilitate the transfer of funds between, companies and individuals, for instance. The majority of these, of course, are done electronically, but there are some that are still done via paper, such as checks. Then kind of briefly we touched on that Banking in Ireland report that I asked you guys to look through on the one of the first weeks, and I suppose some of the takeaways from that and kind of looking at the the IFSC is just I suppose you need a stable and viable banking sector, and that's important for a really well-functioning economy. Ireland needs a safe and stable banking sector, which is reflected through high and sufficient capital adequacy. It has to have a banking sector which has an ability to meet its regulatory obligations and is resilient in the face of shocks. And the banking system also needs to be able to protect consumers' funds and data. In terms of Ireland's success in the international banking arena, I suppose that's really been down to the fact that, particularly post-Brexit, I suppose we're the only English-speaking country with a common law tradition in the Eurozone. We'd also be widely seen as a very business-friendly culture, well-educated and flexible workforce, quite an international workforce, and in many respects quite a stable political and economic environment. Then briefly, just looking at, I suppose, the variety of ways we pay today. They are I suppose, cashless in nature and can range from electronically via banks to the use of mobile wallets. Now, just looking at this slide and working from left to right, we will deal first with electronic payments. So looking at electronic payments via banks, these range from bank transfers to card payments. So in terms of, I suppose, bank transfers, the most common form is a direct debit, which is typically how you pay for your phone bill or your electricity bill, where you will sign an instruction with a provider which allows them to take a variable amount from your account every month or every 2 months or whatever the case may be. The other common form of bank transfer then is a standing order, where you're providing a commitment to pay a fixed amount every month or quarter to another party that's providing you with goods or services. In this instance, you might think of a mortgage payment. Looking at the contactless payments then on your slide there, most of the aforementioned debit cards have a contactless feature, which allows for you to pay for things up to a limit of €50 before you've got to insert your PIN. Finally, you've got these next generation or next gen payment methods, such as e-wallets or mobile wallets, where a bank account can be linked to the e-wallet, e.g. something like an Apple Pay on the smartphone. And I suppose what's interesting is that the payments in ecosystem isn't now purely the preserve of banks, but there's a variety of players involved, ranging from Apple Pay to Revolut, etc. This slide then just kind of runs through the advantages and disadvantages of a cashless society. But sure, look, I suppose the most obvious one there is for customers. It's clearly cheaper and faster than waiting days for a check to clear. For society, it clearly will reduce tax avoidance when things are done electronically rather than being done on a cash-based system. But on the flip side, then you've obviously got IT vulnerabilities, and in addition to that, maybe older vulnerable people are less comfortable with a cashless-based system and find it more difficult, and maybe that reduces financial inclusion. Finally, then on that chapter, we just kind of looked at fintech very briefly, and fintech or financial technology has been, I suppose, a leading force for change in the finance industry, particularly banking, over the past decade, impacting market structures, competition, and financial stability. Fintech then obviously encompasses a range of activities that they range from, I suppose, digital payments, crowdfunding, as you can see on the top of that fintech tree. These fintech activities are often facilitated by enabling technologies like artificial intelligence, which is very in vogue and in the news a lot at the moment, in the middle of the tree. So you might think, for instance, a robo-advisor at the top of the tree provides financial advice, but with sort of limited human intervention. Then at the bottom of that kind of fintech tree, you see the policy enablers, or I suppose, effectively what government or the regulator does, whereby ensuring policies and procedures are in place to ensure your data is protected when you're utilizing a service at the top of the fintech tree, and ensuring that there is proper protection provided against cyber attacks, for instance, and that your data is safe. In terms of the fintech revolution, or should I say, in terms of the impact of this kind of fintech revolution on the banking industry, the Basel Committee study kind of covered this, and they're kind of different scenarios. They cover kind of different scenarios ranging from a better banking industry where incumbent institutions overcome their legacy infrastructure and are able to partake. And there's also a scenario where some of these legacy banks effectively get disintermediated by fintech and big tech. So, for instance, you have a scenario where existing banks invest in tech in order to better digitalize and improve the customer experience, like we have with the likes of AIB and Bank of Ireland are doing at the moment. We have a scenario, obviously, also where new or neobanks, which are, I suppose, digitally advanced and provide a much better customer experience, and they're able to scale and kind of cannibalize traditional banks and some of the activities, for instance, Revolut are able to do. They're obviously just taking market share away from the main banks. Then in terms of distribution banks, in this scenario, so banks and fintechs compete for customers, but also cooperate in niche markets, i.e. provide kind of plug-and-play services on digital interfaces. For instance, how Apple Pay would facilitate MasterCard holders to pay for goods via the Apple phone rather than via card. And then you've got regulated banks. In this scenario, incumbent banks will leverage their banking license to provide deposits and lending services and other regulated financial services, to customers, but the actual tech companies will actually manage the customer relationship. And then I suppose you have that kind of final scenario where banks are no longer significant players because the need for balance sheet intermediation or kind of a trusted third party is removed. And this happens through, for instance, peer-to-peer lending programs. And for example, you'll know there's a website there, it's called Property Bridges, where you could go in, for instance, today, and you could part finance the development of an apartment block. And, there's no involvement in the bank there. The bank has been completely disintermediated. So, just looking at chapter 2, and again, these are the early chapters, and there's only so many learning outcomes or so much examinable material from it. But financial intermediaries, we just noted there that there's deposit taking versus non-deposit taking institutions, and I suppose you just want to have an understanding of the difference. Core banking services, we've touched on the core ones there. You've got loans and deposits, trade finance and cross-border services, along with payment services. We just touched on, the Irish retail banking landscape and I suppose the IFSC, and why Ireland is an attractive place for banks to locate. We looked at kind of the pros and cons of the cashless society. We looked at the fact that fintech is a leading force for change in the banking sphere, and there's both opportunities for banks to participate in this, provided they're adopting the right digital technology, and in some instances and in some markets they'll effectively be disintermediated by technology. Okay, on to chapter 3 then. So I suppose what I would say here is what we're looking at here, I suppose, is really the distinction between what was termed traditional banks and modern banks, or modern banks could also be referred to banks that provide a more universal service. Traditional banks are involved in taking deposits and making loans. You earn interest on loans and pay out on deposits, or you pay out interest on with the difference, your net interest income, which should be a positive number and a driver of your profitability or the bank's profitability. That was the way most banking was conducted up until around the 1980s, when commercial banks then were able to get involved in such activities such as stockbroking, investment banking, etc. The EU then kind of designated that model as a universal banking model, and those entities that undertook a variety of financial services activities, were broad ranging. You can see some of them there beyond just loans and deposits. You have there on the right hand side, you've got them providing insurances, pensions, and all that good stuff. As there was a much wider range of services, not only do those universal banks have net interest income, but they also have fee income, which can come from selling a pension or being a corporate financier on a big corporate deal. Now, I suppose the sector, through these changes, effectively became less regulated, and when you get less regulation combined with more globalization, you get more competition. That competition clearly brought positives in terms of greater choice and a more attractive products for the end customer, but it also resulted in greater risk. And there was clearly excessive risk taking in the lead up to the global financial crisis back in that 08-09 time period. And it caused a variety of problems for regulators that they've kind of subsequently had to roll back, and they've been asking banks to take on more liquid capital to ward against potential financial risks that may come down the line, and to prevent a scenario like what we saw in the 08-09 financial crisis. So then, just looking at the types of banks, and I suppose this is a good illustration of the different types of, or the different divisions, should I say, within a bank. So we might kick off on the right hand side, and I suppose this is the one that may be most familiar to you guys, but the retail and personal banking, they're essentially financial services provided to customers like me and you, and it's quite small scale in nature. Typically, transactions are large in volume, but they're low in value. Customers are individuals, households, and small enterprises like shops, shops, a local electrical retailer, etc. And in terms of the services provided, that's kind of current accounts, credit transfers, direct debits, loans, mortgages, all that good stuff. On the wholesale banking side, this kind of contrasts with the retail banking, in the sense that you're providing services to very, very large clients, such as other banks, other financial institutions, government agencies, and large corporations, and there could be a significant international dimension to what's being provided there. On the corporate banking side of the tree, this relates to the provision of traditional services such as loans and deposits, but just on a large scale to big clients. On the investment banking side of the tree, just on the right hand side of that, you'll see that involves helping businesses if they're trying to acquire another business, they're trying to merge with a business, they're trying to raise money from the stock market or the bond market or what have you. And then finally, you've got the whole concept of private banking. And essentially what we're talking about here is really just tailored financial services for high net worth individuals and their families. And we'll just touch on that in a bit more detail on the next slide. But just as you can see there, as we noted, it's really just a provision of high quality financial services to very, very wealthy people. these services, they can range from, loans and deposits to more bespoke things like estate planning and wealth management and all that good stuff. And what you can see there is it just kind of breaks down where you need to be one of these high net worth individuals. But essentially, effectively a lot of people would have a million or above in investable assets to be having the use of one of these. Sorry, I skipped the slide there. Apologies. But one of these kind of high net worth individuals, you'd want to have investable assets of kind of a million or above to probably be using using the services of a private banker. Okay, so then looking at another concept we touched on in this chapter was probably bond features. Now, large companies can also raise funds in the capital markets by issuing debt instruments known as bonds. So again, we just touched on what was a bond. So bond represents a promise by a borrower, either a government or a corporate, to repay a lender the amount borrowed, along with an annual interest or coupon in kind of regular installments. The most important feature relating to a bond is the credit quality of the issuer. Typically, governments, particularly in the developed world, will have quite a good credit quality, as they're believed to be lower risk than corporates, and so they would pay a lower rate of interest or a lower coupon in many instances. Government bonds, as a result, are often deemed as kind of low risk, but then they offer a low return. So many of these governments will have a credit rating of like AAA, so you've got a low risk investment, but it's also a very low return investment. I just remember that. And just in terms of on this slide, and just kind of going from left to right in the bond features, so issuers can be, I suppose, a government or a corporate. In terms of priority, you've got senior debt. This is also, it's also known as unsubordinated, and junior debt also known as subordinated, but just keep it to senior and junior for the moment. And the key thing to take away from that whole concept of senior and junior is that senior ranks higher than junior. So if something goes wrong, the senior debt holder has to get repaid first. You've also got the whole concept that bonds can be callable, convertible, or puttable. And I suppose, what does that mean? So a convertible one is probably the easiest. That means that you can convert the bond into shares in certain circumstances. So you can convert that bond that you hold into shares in the company in certain circumstances. A callable bond then is, so I own company A, I issued a bond, I take the money from you, the investor, for let's say 10 years, and promise to repay you the money and the interest. However, if that bond is callable, and even if there's 9 years left before it matures, I can decide to repay you your money, and therefore it will free me from the interest payments. A puttable bond then is the exact opposite, where you're the investor, or where, should I say, you as the investor has the right but not the obligation to demand the repayment of the principal early if you wish to do so. Okay, so then just in terms of the summary points there on chapter 3, so we kind of dealt with traditional versus modern or universal banks, and we just kind of, I suppose, reviewed the table, and it's just important to review it, and I suppose beware of the key differences there. We touched on the different types of banks, be it, wholesale versus retail, corporate banking versus investment banking, and then also we touched on what private banking is, and essentially you have $1 million worth of kind of available assets to invest in. You'll be using a private banker. We touched then briefly on bonds, and a bond again represents a promise by a borrower, either a government or a corporate, to repay a lender the amount borrowed, along with an annual interest or coupon Government bonds are, as I noted previously, they are deemed low risk and low return, so they will typically be rated AA or treble A, but as a result you've got a very low risk investment, but it's also very low return. We also touched then in briefly the differences between senior and junior debt, and callable bonds, convertible bonds, and puttable bonds. Okay, next one. So just to flag as well, obviously, on the second side there, you would have noted we had briefly touched on Islamic banking, but it's not examinable, and we would have said that on the time, just so if you see me skip past the chapter, you'll know why. So in terms then of chapter 4, so I suppose we kind of get into the product life cycle here, and we also dealt with theories on why banks enter foreign markets. And the most obvious one there would be to, I suppose, follow your multinational clients. So say your big client is Coca-Cola, they expand into Europe. You, as the American bank, they already trust you, they have a great relationship with you. So if you expand with them, you have a great chance of winning the business if you kind of set up a European operation. And maybe you might have Coca-Cola, McDonald's, and a couple of others, let's say in this hypothetical example. Diversification is another good reason. So, for instance, we would have seen Irish banks during the financial crisis. They were primarily focused on the Irish market. So when Ireland went into a deep recession, they clearly struggled to write new business. If they had more of their operations in the likes of an Australia or China over that time period, they obviously would have been able to do much better. So in many ways, while expanding into foreign markets, it could be seen as risky from some perspectives, because you're not going to know this new market. From a diversification of earnings perspective, it actually could be less risky and quite a positive for your business model. Now, there's two types of diversification. We just kind of touched on geographic diversification, but then there's also this whole concept of product diversification. So rather than just selling mortgages and deposits, you might also offer insurance products, for instance. So hence, if there's a downturn in the economy and your ability to write good loan business is impaired, at least you'll still be getting kind of resilient earnings stream from the insurance business that you may be writing over the period. Another reason for I suppose a need for diversification is the whole concept of the product life cycle, as can be seen in this chart. So an innovative or new product, when the goods or service is produced to meet a demand for a new customer, I suppose that demand will usually emanate from, I suppose, wealthy, mature and developed countries in the first instance. And at that stage, the product isn't standardized. The bank is still testing demand. It's refining the offering. So there's a lot of money put behind it. During that stage, the product is new. It's not widely available, and due to the whole concept of supply and demand, the product will be priced highly. As the bank becomes more efficient at producing the product or service, there's going to be natural learnings. It'll become more standardized and more widely available, and obviously other banks will copy then what you're doing as well. And as it becomes more widely available in the market becomes mature, and it's quite likely that customers in the bank's home country will be prepared to pay less for that service. So at this stage, banks will clearly have reduced, I suppose, production costs due to economies of scale, and they'll look to roll out that product or service into new markets, obviously starting with high-income foreign countries where the product will be new, and hence the bank will be able to charge a reasonable price for it. And that process whereby innovative products, where they're first produced and sold in one prosperous company, and then they trickle down into other countries which are marginally less wealthy. That whole concept is called product diffusion. and it was quite widespread in the banking industry in the 1960s to 1990s. And the credit card is a very good example of that. And then I suppose the final stage of that product life cycle, should I say, is, I suppose, the standardization of the product, when the product is very undifferentiated and competition is widespread, as other banks have kind of copied it and brought on their own versions of the product or service. Once the product becomes commoditized like that, there's a downward pressure on price, and in order to make a profit from it, it has to be produced in a low cost country. But that kind of covers the main points there on the product life cycle. So just briefly, I suppose there's different types of entries into a farm market. And first off, you can see there's a correspondence bank. This is where one financial institution provides a service to another one, usually in another country. So the correspondence bank acts as an intermediary or agent, I suppose, facilitating a variety of services ranging from, accepting deposits, conducting business transactions, etc. And then you can look at most of the rest of them in your own time, but that's the kind of the low level entry is the correspondence bank. And then that high level entry into a new market is the subsidiary bank. And this is a separate legal entity from the parent bank. It has its own capital. It's organised and regulated in accordance to the laws of the host country. Subsidiaries may be the result of an acquisition, or it could be an organic startup. They tend to be costly, as the business will have to be capitalised separately from the parent. But I suppose the one advantage of having a subsidiary is, I suppose, it signifies a very strong commitment to doing business in the country, and it will help you attract more business as a result. Just on this one, then, it just kind of touches on the opportunities and challenges of cross-border banking. And I suppose, as we've kind of noted previously, one of the key benefits of cross-border banking, should I say, is risk diversification, as the assets of cross-border banks will be less exposed to country-specific shocks. Customer retention, if doing the work for, Coca-Cola in one market, you have more of a chance of winning it in another market if you follow them. In terms of market opportunities, you could think, for instance, like a Portuguese bank moving into Brazil. They both have the same language, therefore you're going to have an edge versus maybe a North American bank going into that market. In terms of challenges, then, look, you'll be dealing with regulations that could be very different. It could be quite costly to interpret them and to adopt these sort of regulations. The expansion ultimately might just not work out, because you're entering an emerging market where the rules of engagement, etc., are a lot different. For supervisors, then, or I suppose the country's central banks, there's opportunities and challenges. Clearly, the opportunity is it increases competition. For instance, you'll have seen the likes of Avant Money have entered the Irish mortgage market, and at least it has had some impact on pushing down loan rates marginally. But I suppose on the other side of that, you've also got to monitor these institutions very carefully to make sure that there's no risk or kind of financial contagion events that could impact your own jurisdiction as a result of these new banks being set up and being regulated in your country. So what about the role of banks in international trade? Well, it's important to understand, I suppose. And this is quite a good slide, and I pay attention to it. So firms involved in international trading activity, either as importers or exporters, can rely on the banking system to provide various forms of trade finance to help facilitate the import and export of goods. A letter of credit is a legal banking agreement that allows importers to offer secure terms to an exporter. A letter of credit from a bank kind of guarantees the seller that if various documents are presented, the bank will pay the seller the amount due. In simpler terms, I suppose it's an undertaking given by the issuing bank on behalf of the buyer to pay the seller a specific amount of money on presentation of specified documents representing the supply of goods within certain time limits. In addition, I suppose the seller can also raise extra finance using a letter of credit as collateral if needs be. And the attraction from the buyer's perspective is that they do not have to pay cash up front to a company in a different country before receiving the documents of title for the goods that they're actually purchasing. And this is, of course, very, very familiar, or very, very useful when maybe the buyer and the seller aren't familiar with each other, and obviously it boosts global trade. So look, I pay attention to that side. Okay, then the concept of syndicated lending. Can anyone give me does anyone have an idea what syndicated lending means, or can give me a definition, given we covered it in lectures? And again, don't all shout at once. Okay, so syndicated lending is when a lead bank persuades, I suppose, a number of other banks to contribute to a loan for a single borrower. So it's a collection of banks lending to a single borrower. Now, normally a syndicate of banks will be used when providing a very large loan to finance a project such as an infrastructure project, for instance. I suppose it can happen in developed markets with very large transactions. And when we dealt with the whole concept of syndicated lending, we talked about Elon Musk's acquisition of Twitter and how syndicated lending was involved in that whole process. But again, just an area I would pay attention to. So why would a company go for a syndicated lending arrangement rather than just doing a bond issue? Well, I suppose arranging a syndicated loan can oftentimes be less costly in terms of setup fees compared with a bond issuance. Syndication allows borrowers to raise large sums, I suppose larger sums than they would be able to obtain through either a bond or an equity issuance, particularly when they're under tight time constraints. And the facilities can be arranged quickly and discreetly, which may be of value for certain transactions, particularly takeovers. So you'll want to be very discreet if you're trying to do a takeover. If not, and if word starts to spread in the market, clearly the price of the acquiree could go up in value. So again, just I pay attention to syndication. The next one there, I'm not going to walk you through the syndication process. It's kind of all detailed on the slide there. I'd only be regurgitating what's on the screen. This one, I'd pay attention to this slide. It's quite simple, but it's important. So there's I suppose three main rating agencies, two of which are detailed above. So there's Moody's, Standard & Poor's, and Fitch. Now, when an institutional investor or big fund gets involved in a syndicated loan, they will do so oftentimes through a special purpose vehicle called CLO, or or collateralized debt obligations or collateralized loan obligations, which essentially hold a collection of loans in a kind of special purpose vehicle or a company. And this SPV will contain a variety of levels of debt based on how risky they are, and its credit rating. The credit rating agencies will look at the collection of loans that are within this SPV and give a credit rating to it, and the potential investors in the SPV will assess the credit rating, and it'll be one of the key things that feeds into whether they decide to purchase that SPV or get involved in the CLO arrangement or not. And just to remember that whole concept of a AAA bond effectively will give you a low return, but it's also very low risk, versus if you're looking at something that's at the BBB level really, or below, it's something that will be higher risk but will give you a higher return. And that's kind of the key point to take away. So just in terms of the summary from this chapter, so in terms of international banking, I suppose banks go overseas for a variety of reasons. Diversification of earnings is one reason. We brought up the whole concept of the product life cycle, and I suppose that's another reason why you'd have to, I suppose, send your product abroad. There are different entry structures for foreign markets. The easy one and the low risk one is that kind of correspondence branch, and the most, I suppose, the one where you have to put down the most amount of capital, but you probably will make more of a success of it, is the subsidiary, and they're kind of all detailed on the slide. We touched then on cross-border banking, and it brings many advantages, but it also brings a lot of disadvantages, and they're detailed on the slides, on the previous slide, should I say. In terms of the roles of banks in international trade, I suppose they're key conduits in the facilitation of international trade between importers and exporters, and we touched on that whole concept of the letter of credit, and that's the thing I definitely want to know. In terms of syndicated loan, it's a credit facility made available to a borrower by multiple lenders under a single loan agreement to a single borrower, and I would remember that as well. And then we just obviously touched on credit ratings. So we have got now as far as chapter 6, and as I recall, chapter 5 was the Islamic banking. So we just have to go through 6, 7, and 8. But just given the fact that it is 18:52, we might take a break there and come back at 7 o'clock, if that's okay.